Hey, welcome to the podcast, everybody. Thanks for joining me here on this Wednesday afternoon. Well, the stock market is now closed, and if you're just coming home from a hard day at the office and you didn't really check in on the market and you look what happened today, Dow Jones down 6 points, ho-hum, no big whoop, right? The utilities down a little bit, Russell 2000 up on the day, mid-caps up, the S&P eked out a 2-point gain, NASDAQ up 11 points, not too bad. Then you take a look at the intraday chart of the markets, and you will see here that we reached a low of 12,311, which was down about 190 points at one day around lunchtime, only to see the stock market pretty much finish flat on the day. Not a bad rally going from 12,311 all the way up to 12,494, 496 where it finished. The bottom line was, it was a tale of 2 days, or two situations, I guess, as it were. This is where the market opened up this morning, right here, and then we went down, and then we went up. So it's hard to analyze a day like today because it was during this whole sell-off, we have not had a 90% down day, I don't recall. And I may be wrong about that, but I'm pretty sure that's the case. But we were at 90% down day as of middle of the day. It just didn't close there. So it's hard to analyze until we get these closing numbers because a lot of analysis I do comes after the market's closed once we have everything stops moving. It's like chasing a carrot around during the day. So it's hard to analyze it. Net, you would expect what we saw was a very mediocre day, obviously, because it finished kind of flat on the day. Today was interesting in the fact that we did have a higher volume. So in the last 3 days, even though the volume has been lower than what we've seen, it's still been higher than average. And we did see that reversal, so you'd expect a little more. So we were oversold the last couple days. As I mentioned on the last podcast, I covered my short on Friday. And then, of course, Monday, feeling pretty good about it. Yesterday, the rally that was there went away, obviously. And then today, it's down 190 points. It's, it can't even rally from an oversold condition. And yet, whether it's a European rumor that comes out or whatever the reason, we start to see the market rally. I think this is the definition of volatility. Okay, when you have volatility like this, you basically have to not get too cute because you can get whipsawed very, very easily and very quickly. So what we have now in the short term is basically a little trading box. And what that is now is that we have fallen down, we went up to the top, we went back to the bottom, and now we're about 3/4 of the way back up to the top, right in here. Okay, that's where we closed. So if we get a breakout above this area, then you can say, okay, now what's going to happen is, the 50-day, the 100-day moving average now becomes the line in the sand, and is that the spot we rally to? I'll clear this off and show you, and this is going back to what I discussed earlier, I think Saturday's podcast, maybe a couple days ago. But this is the spot we could rally to pretty easily. And as we rally back up here, again, what is the quality of that rally? So far, the quality of the rally has been weak. We saw the rally on Monday. As I told you, it was weak based on my work. And sure enough, we didn't get any follow-through the next day, and then we had the sell-off today. One thing that's good about today's rally is that oftentimes bottoms do tend to happen intra-day. And because they happen intra-day, it shows you that the selling's exhausted, at least temporarily. Again, I'm not making the case that this is a buy-the-dip bottom here. In fact, I'm still on the side that says we probably want to actually look to reload on shorts at a higher level, meaning sell the rallies, not buy the dips. I'm just not going to do it down at these levels because so many oscillators that I watch are still oversold. Now when we zoom in here, you can see we are making little bitty higher lows, right? Just enough to keep people that are bullish to go, aha, we couldn't break down through roughly the 1300 area, I guess would be your support or your line in the sand where it's holding up above 1300 just so, and it's barely getting there. Now today, and I mentioned it on Twitter, and if you want to follow me on Twitter throughout the day to get a little more current information, twitter.com/Karl Eggerss, you can do that. If we look at the 5-minute chart on the S&P 500, we did breach the 1300 level just briefly, and we went below it right in here. And during this time frame, I was pointing out the fact that I said I think this could be a fake breakdown, and that it was going to give this rally, it was going to give it another try, and that was just some positive divergences that I was seeing intraday. And so we did get the rally, and then it looked like it was going to start failing again, and then we, of course, had that big burst at the end of the day. But that's what you have to be careful of when you use round numbers like 1,300. If you're sitting back there, whether you're a short-term trader or not, and you're using a number like 1,300 to say, if it falls below 1,300, I am going to sell everything and go short, sometimes what happens is right when it breaks through that line, all the sell orders get filled, everything gets exhausted to the downside, and then because of the lack of selling at that point, not because there's necessarily a lot of buying, but a lack of selling, we start to have a supply-demand imbalance and demand takes off. Okay, now again, that did coincide with potentially some rumors out of Europe maybe. I don't know. I didn't look at the tick-by-tick on that particular thing, but I'm just telling you that 1,300, which a lot of people are watching, is kind of the place where it has to hold, it has to hold. Well, it didn't. It didn't hold today. In fact, if we look at this, the low was 1296. So there's people selling because it went below 1,300, and then it just recovered a few minutes later. So be careful about these round numbers. Sometimes it's better to squint at these things than really zoom in very closely. But if we look at the daily picture of this again and kind of go back to this, I think what you see is yesterday the bulls were very disappointed, because those who bought on Monday's opening or covered their shorts like I did on Friday, what they were hoping was for this continuation, and we really didn't get it yesterday, right? Because it sold off intraday. In fact, if we go back and look at this, and I'll zoom out a little bit to show you yesterday, we rallied in the morning, but it peaked about 2 hours into it, and then it sold off the rest of the day. That's not what you want to see. So the bulls were disappointed. On the flip side, people that were short were very disappointed today. But if you look at this, you'll see that this was the top, is what it's telling you, and today this was the bottom. So, for those that bought at the top, they were very disappointed yesterday. For those that shorted at the bottom, they were very disappointed today. Net, look where the stuff opened and closed in a pretty tight range. So I don't think it's very conclusive which way this is going. I will just tell you that overall, I still think that the stock market is oversold and can rally, and I wouldn't be surprised for it to rally up to that 50-day moving average. Now, if you look what's happening here, you'll notice that we're coming up against where the 20 is now crossing through the 100-day moving average. It's already crossed through the 50. That was earlier, back at the beginning of the sell-off, and that was kind of when things intensified. But overall, I have this line of support in here, and so I think we're setting ourselves up for, again, now I drew a little mini box earlier, but really I think the bigger area is going to be somewhere in here. I think this thing does work its way up to the top of this, and then again, is it accompanied with much stronger volume? So far it hasn't been, and the quality of the rally hasn't been great. But I will say, I tend to have seen bottoms generally when markets turn around in the middle of a day than just start going up the next morning. So that's a bullish thing. And I think one other thing that I pointed out, and again I pointed this out on Twitter, so if you're not looking at Twitter during the day and following me, if you want to, I think it would be helpful, because I pointed out that if you look at the stocks like Apple, which I mentioned that I picked some up on Monday, if you look at Apple, what happened, it was holding in there all day. Remember, even around noon, the stock market was way down, right, 190 points. Apple was only down maybe a buck or two. And then when the market recovered, it recovered. If we look at companies like Starbucks, same thing. Look at this. It was going sideways while the stock market was going down. In fact, if you look at this, I've put the S&P 500 on top of Starbucks, and you'll notice that, again, as the stock market was heading straight down, the stock market, Starbucks was kind of moving sideways. And then once we get the rally, they both participated. So you started to see some stocks that were, even companies that have really been beaten up lately, like Priceline, it was heading down, but it wasn't down a bunch during the day, and then it rallied back. Chipotle Mexican Grill, you can see this was one that had been selling off in the last few days, and again, it was actually going up while the market was going down. So I noticed that early on that you had this leadership, which had been really selling off as fast, if not faster, than the overall market. Today, you didn't see that. Even when it was down 190 points, had you owned those types of companies, those, we'll call them leadership, older companies, I shouldn't say older, companies 3-4 months ago that just couldn't go down. In fact, if we switch over to look at CMG and go back a little bit, you go back to the beginning of the year, this stock just couldn't go down at all, right? It was going straight up. And then as we got into March and April, of course, it's been bumping up against the 20-day moving average, and you can see it's there right now. It's trapped in between the 100 and 200. But the point is that it was leading the market down, and now today you saw it really holding in there throughout the day, even though the stock market was going down. And so I think that's important that leadership comes back, because what that was telling you was these were being used as a source of funds, meaning, hey, I have to get out of the market, so I have to sell not only the stocks I want to sell, I have to sell the ones I don't want to sell, the good ones, the apples, right? Those are the companies I don't want to sell, but yet they were being sold off. That tells you that there was overall selling, not panic. We haven't seen the panic, and that's why it's been an absence of a 90% down day. But we did see some of these stocks go down, and now perhaps that selling has exhausted itself, and you may see selling in other areas, but not necessarily in some of the leadership. So that's something to watch, and I'm not suggesting to run out and buy CMG, Starbucks, or Priceline, or Apple. I do own Apple. I think it looks good, and I own it because fundamentally I like it, and it bounced right off the 100-day moving average. And now the next thing we have to watch for in Apple is this little trend line. Can it break through that? I'll take this one off because that's old news now. So that's the next thing. Can it break above that? And then if it can it again break above the 50, and off we go. So look, they're setting themselves up for an October release of stuff. We're in May, almost June. It's going to start getting closer. We're going to have more talk about it. I think Apple's okay here. But again, I think it's important that the leadership came back today. That's very important. The other thing was treasuries. I had noted again on Twitter that you didn't see, as you saw the stock market rallying from these lows here, it was interesting to note, as this was happening, treasuries were moving sideways. In other words, people weren't selling bonds to buy stocks. Remember, the last couple of podcasts I've pointed out that treasuries were extended and stocks were oversold. But they weren't, today you didn't see people coming out of bonds and into stocks. Stocks were coming up. But at the end of the day, look what happened. As the stock market started its real ascent, finally, treasuries sold off and had a pretty nasty tick down last tick of the day. So for those that are bullish, I think that's a good sign, because you want people to come out of safety trades, which are treasuries, and go back into the riskier trades, which would be stocks. That's what you want if you're bullish. But I think overall, when you look at this market, you have to, this is what volatility is all about, right? It's not just a straight line. Volatility means that things pick up and it becomes confusing for not only the bears, but the bulls as well. So what you have to do is take out some of that vibration. And I've looked at some things very short term, showing you intraday charts. Some of you are investors saying, hey, I just want to know, is this the end of the 3-year run? And I will tell you that, as I've been stating, it sure does have some of the characteristics of the end of the bull market from '09, because you're seeing almost an exhaustion where you're seeing sector by sector get weaker and weaker. And as I mentioned, we need financials to participate. We need semiconductors to participate. We need all these different things to participate. And we need it on not only good volume, but we need high quality volume. And we haven't been seeing that lately. So look, this is not a time to say, it fell, I'm going to jump in there. But certainly you can do some trades that, A, you can keep some tight stops, or B, you can say, hey, these are good companies, they're cheap, and I'm willing to hedge them later on, but I'm going to pick my spot here. But overall, it's too early to say, yes, this is the bottom. And especially because of the fact that things aren't resolved over in Europe, are they? They seem to be getting worse. A lot of big stuff could happen over the weekend. So given that, I'm not making big moves one way or the other. I'm happy with the cash I have. And remember, as the dollar has appreciated, which if we go to UUP, which is the ETF for the dollar, if you're bullish, look what it's done lately. So guess what? Your cash is buying you more stuff right now. It can buy you more stocks than it could a while back. It can buy you a lot more stuff than it could. Gasoline will be cheaper. These are all good things. And so I think overall keeping cash right now is okay. It's making you money. And that's important to realize that you don't have to always be doing something with your money because that can put it at risk. And right now with the dollar going up, your cash is actually making you some money on a relative basis. But getting back to the market, I think that, again, not making any big moves is the right plan. I think overall you're starting to see what may look like a small little uptrend here. And we could work our way higher. Because, again, things are oversold. Let the market breathe a little bit. If you want to do some very short-term trading, that's fine. But in the medium picture here, we've definitely broken down. And if we don't get, and soon, if we don't get some really strong demand that's convincing that the bull run that was there, January, February, March is still intact, then what you have to do is look to reestablish shorts. Because remember, being agnostic about this and buying or long or selling short, in your mind, you should say, I want to have capital gains. I don't care if it's from the long or short side. So looking to possibly reestablish a short up here or up here if this thing rolls over, I think that may be the play. Because this thing could work its way up and then roll back over and head back down. And if it does, we're looking for capital gains. And capital gains, there's plenty of inverse ETFs out there, to take advantage of some of this stuff. So again, stay agnostic, but look what's working, what's not, and especially notice things like leadership. That's very important. That was the one thing that stuck out to me today, was that the leadership hung in there early on. All right, guys, hope you enjoyed it. EggersCapital.com, Twitter.com/Karl Eggers, as I mentioned. There's a subscription for those that don't know. You don't have to go check the website all the time. Just go up to the top right of KarlEggers.com, and you'll see a free subscription. We won't bombard you with a bunch of sales pitches. It's just going to be a blog when I write one or a podcast when I do one of those. You will get it in your inbox. All right, take care, everybody.